So starting with the idea of minimum capital requirements for market risk. Now, FRTB is a guideline from a market risk management point of view. So we will focus on market risk side of things as a part of our discussions. Now, the main idea behind why regulatory capital is defined by respective regional regulators is to ensure that banks have ample amount of capital, i.e., they're well capitalized even if there is any systemic stress or if the economic conditions deteriorate. So the regulators are effectively telling banks that we want you to allocate a capital which is commensurate with the amount of risk which you're carrying on your books, so that even in terms of stress, you don't have to come to us for rescue, but you'll be able to continue your operations and you will continue to be a going concern. So that's the basic premise behind having a minimum capital requirement from a regulatory point of view. Now, most of us will be aware of the Basel III capital requirements. So Basel III guideline has been around for a very long time, and this is a banking guideline which is adopted by banks globally. So when I say globally, the guideline has been defined by the BCBS committee or the Basel Committee for Banking Supervision in Switzerland. And regulators around the globe take that guideline, they make the required tweaks depending on the conditions in their markets and their economy. And those guidelines are published to banks which operate in that particular jurisdiction. So that's how Basel III has been used or consumed by banks over the years. And it has been around for a considerable amount of time. So if you read a few things on history of the Basel guideline, we started off with Basel 1, then 2, 2.5, 3, and so on. So post this, in now Basel 3 also has a few shortcomings which we try to overcome as a part of this new guideline, which we call as the FRTB, which we'll understand as a part of our discussion. So FRTB will be seen as an enhancement over the current regulatory framework. A lot of things are happening around FRTB. So globally, if you observe, there is a lot of development which banks are doing from the FRTB point of view. So FRTB guidelines are very, very comprehensive, and regulators globally are setting specific milestones which banks in those respective jurisdictions will need to meet so that they move smoothly or transition smoothly towards adoption of FRTB. And the FRTB guidelines are expected to be more stringent as compared to the existing guidelines. We'll see more about these things in our subsequent slides. Now, certain enhancements which the FRTB guideline has recommended have been given below. So the main idea will be focusing on the revisions which FRTB is suggesting over the current framework. So we start off with our discussion on usage or consumption of risk sensitivities. Now, risk sensitivities will help us understand linear and non-linear risks in a much better manner. So there's a detailed discussion on what are linear and non-linear risks and how do we calculate that in our subsequent slides. We will be coming to that. Also, currently, we are sticking to the IRC idea. So the current guideline talks about incremental risk charge. Now, the proposal under FRTB is to replace the IRC with the default risk charge or the DRC model. Also, there is a revision which is defined between a banking book and a trading book. Like we know, these are the two main classifications into which bank will allocate its positions, be it asset or a liability. It's going to either fall on the banking book side or the trading book side. And the reason why this boundary has been clearly defined as a part of FRTB is because we want to prevent the possibility of any regulatory arbitrage which banks might try to gain by switching between these books. Also, the current 10-day horizon for VaR has been replaced with 5 categories of different liquidity horizons. So the main idea behind why we require these liquidity horizons is to mitigate the risk of sudden and any severe liquidity impairment which we may observe across asset classes. And there is a focus on usage of expected shortfall. Now, some of us might have studied expected shortfall in the past. So expected shortfall is like a conditional measure which is beyond value at risk. So before we use expected shortfall in our calculations, we will be doing a brief review on expected shortfall as well, so that we are comfortable with the concept and we'll be able to then understand it well from the FRTB point of view. So the usage of expected shortfall under stress conditions, and the reason for this is this would provide a better measure of capital, especially during periods of stress. So if you observe, there is a lot of focus on how exactly the banks would be able to tackle things whenever stress scenario builds up. And I think that's an important idea or an important notion, because market stress can build up at any point in time. And when the stress builds up, those kind of systemic stresses build up very, very fast. So at that time, there is hardly any time for any market participant to respond. So if by having a robust guideline like FRTB in place, we are ensuring that banks are robust enough in order to tackle any kind of stresses as and when they show up, and they continue to do their business as usual and remain as a going concern.